Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, everybody, welcome to another episode of Wealth Wisdom. We are back. It's Friday, another filming day, and we are ready to go. There's a lot going on in the markets. As always, I am with my two best buddies here, Eric Benz and Bill Ryan, Fox Hill Wealth Management. This is Wealth Wisdom. Don't forget to subscribe, like, share, follow. We're bringing you this week. We really dive into what's going on in the markets today and why we're not panicking. We're not worried at all. We'll get into the deep details with Bill and Eric in a little second, but really, how this is a healthy situation and what's going on today. So is it tariffs? Is it something else? We'll dive in. Just quick
mild heart attack, we just call it a healthy situation, but
it's quick. Hey, sometimes it's no
one
big
of those
deal.
things. It's like, I always say, like, I'm not that nervous, but I am kind of nervous, but I'm not nervous, right?
Everything's fine. Everything's fine.
Everything's
Does that mean?
fine. Remain calm, right?
Yeah, everything's fine. No, let's dive into it. Markets are down, right? That's the fact right now. Eric, what do you think? A lot of people are saying it's tariffs, and then recently it's saying it might not be just tariffs. It just might be other market conditions. But right now we're in correction territory.
The market was at incredibly high valuations. Tech stocks with PEs of like 50 and plus. Some of the mega cap companies like Google, Apple, Microsoft, all with PEs of like 35. I was looking yesterday. Now Google's price to earnings ratio is back down to 20, which is a very attractive valuation.
Mm-hmm.
So
I think they're saying the same for NVIDIA too.
Yeah, so it could have just been that the market was running hot.
No.
Certainly tariffs didn't help. Like, the market hates negative news. People see the tariffs as negative news, and there seems to be new tariff news every day.
Yeah.
You're going to tariff me? I'm going to tariff you back.
Reciprocal tariffs.
Every
Yeah.
day now.
Double tariffs, triple tariffs.
Yeah.
I think they just did a 200% tariff on luxury goods coming from Europe yesterday.
Yeah.
So
Well, that was the photo of Trump with his wine glass.
That's right,
and,
on all
that was
wine. And I think it was retaliatory. I think they put 50% tariffs on whiskey.
Yeah.
Oh, an American whiskey.
Yeah,
Yeah.
exactly.
That was going on with Canada, right? There was saying how, so
Little tit for tat.
sorry,
Eric.
American whiskey.
No.
Yeah.
Good flow. Good flow of conversation. But I just wanted to reiterate what tariffs have gone through super quick.
Yeah.
Canada and Mexico, 25% import tariff on goods. Steel and aluminum, 25% across the board. China, Trump added an extra 10% tariff on all goods coming in from China. EU, Trump's threatened but hasn't enacted 25% across the board there.
Mm-hmm. Well, there seems to be a lot of whipsaw. It's like one day we're going to do it, tomorrow we're not.
Right.
The markets can't like that
copper,
either.
lumber, 25%. And then reciprocal tariffs going into effect April 2nd, across the board.
Yeah.
So it's a lot. And it's every day.
Every day.
Every day.
Yeah.
Yeah, even with the market reacted short-term to positive CPI numbers, and then there was more tariff news. So, yeah.
Right,
I
CPI
think the market will get
came in
used to
great.
it,
Right, inflation is down
yeah,
at 2.8%, which is fantastic.
Yeah, which that's the big fear, right? Is that all the tariffs will lead to higher inflation.
Yep.
But maybe the tariffs still need more time to take effect, and then the economists will all be like, "See, we were right." But for right now, we've seen inflation actually tick down slightly.
Right.
Yeah, but they haven't really been in place, so we haven't seen the cost of goods change. You know what I mean? So, and again, that's a backwards looking, right? That's a one
Yeah.
the inflation report. It's backwards, so not going to show if the cost of goods are, moved up, right? Because companies want to maintain their same profit margins. So they're going to, they'll change those pricing. Prices go up, inflation, right? So
Yeah.
So we'll see. We'll see what happens in future reports. That's really going to be the problem. Is that those inflation reports are all backwards looking, so they're not going to be the greatest indicator for us. You know what I mean? Of where it currently is. So
Yeah.
Right. I assume, which is probably why companies like Walmart dropped pretty quickly, was their forecasting is probably a good indicator where they said, hey, EPS for the next year, we believe we're revising our estimates downward. And we saw all those companies revise downward across the board. So that's probably a good indicator.
yeah, they're going to have a huge issue with pricing power, right? You know what I mean? Things like that. Obviously, they have a great just due to the volume and stuff that they do. They have the ability to change their pricing and affect pricing in a lot of ways. But having a tariff like that on a lot of their goods, obviously they import probably a ton of their stuff. I mean, I don't know what the numbers are. I would love to see how much stuff that Walmart sells that is made in the U.S. I'm sure it's not a ton, but
Right.
yeah. So they're obviously going to be hugely affected, and then who's going to be affected by that, right? The buyer who goes to Walmart. So
Yeah. It's interesting. And this correction right now is one of the I think the fifth fastest on record. Do you guys feel that, I'm sure a lot of clients are saying, hey, or just people in general, right? If you're listening to the show or watching, that the automatic, I think, normal emotional reaction is to say, like panic, let's get out. What are you guys saying to clients? Are we buying the dip? What's going on in your heads regarding the market, like decline right now, the correction territory we're in? Is this a healthy moment for the stock market in general? A lot of people are saying we're going to have a great summer.
Yeah, it's stay invested, buy the dip, add funds, all the above there. Market corrections are normal; they happen all the time.
Yeah.
Over the past 75 years, we've had 23 corrections of 10% or more. Like you said, this one's the fifth fastest.
I'm surprised that's it.
But
to be honest with you,
I mean, a lot of times you might see the market dip 7% or something like that, and because it usually hovers near its high. But that being said, this correction was quick, but it mostly was giving up the Trump bump from a few months ago. So it's not. I don't think it's anything that crazy.
Okay, you got to zoom out a bit.
Yeah, exactly.
it was almost
it's
euphoric, right? Euphoric markets, like when all that stuff was going on. So
Well, it's frothy. Yeah.
Justin, do you want to share that chart that has the corrections listed? I don't know if you have that capability.
Well, certainly, if I can't do it on the fly here,
Or is that in
do
after?
it. Yeah, we'll put it in post for everybody watching here. We'll edit it in, but it is remarkable. I'll share it with you guys. I wonder how this will.
Yeah, corrections happen all the time, but market all pretty much bounces back significantly afterwards. Yeah, average 12-month return after a correction is 25%. So that's the time to get in. That's when the rich get richer because they have discipline and they stay invested for the long term.
I mean, it's like the Peter Lynch, who's head of the Contra Fund for Fidelity for the longest time. Far more money is lost, right, when people trying to sell at the bottom, right? Then that's where people lose their money, right? Is because they get out at the wrong time, than staying invested. So these things are. Again, every time it happens, right, this time's different. We haven't seen these type of terror. We haven't seen that, right, you're going to hear a lot of this stuff. We haven't seen this type of, whatever the excuse is, right, is, this time is different and we're not going to be able to, so it creates that, again, that euphoric feeling, just in a negative way, right, as opposed to a
Yeah.
When the markets are chugging along, people are putting too much, you know what I mean? They're putting money in, and they're maybe trying to put in too much money, right? Trying to catch something, rising to the top. Really, like, that's why you want to get a plan, stick to it. Think of it as, a multi-year plan, right? How would you attack this over 3 to 5 years? You know what I mean? Not
Right.
what's going on right in the moment.
Right.
Yeah. Bill, why I pulled up the chart. I think you guys can see it right now. I mean, this chart's fantastic. If you're watching this, you just screenshot this. But walk us through it a little bit, Bill.
Yeah, I mean, it's dating back to the 1930s, right? Or 1920s, I should say. And it's just going over all these, these different bear markets that we've had and what the market does following, right? You're in these things. So some of them are short in nature, right? 6 months, 3 months, right? But there's other ones, obviously, that are longer, right? So we've got, obviously, like in the Great Recession, you know what I mean? Way back in the 30s there, that one was obviously much longer. We've got other ones that, that did last, close to 2 years. You know what I mean? That was a drawdown over, we'll call it like 2 years, right? Or somewhere around.
The .com, I think, is .com bubble. Is that one that is right here?
Yeah, I think that's the one right there.
Yeah. 24 months, 25 months.
25 months.
Yeah.
Yeah.
Then afterwards,
yeah. But even the .com, though. Now, not if you stayed in the NASDAQ, but the overall market was back to where it was, I want to say, in like 2 years, right? So you were back and making money again. Sure. And I think same thing you did with 2008. That obviously was, hopefully was kind of a once in a lifetime, financial crisis where you look at all the things that went into that. But that was, I want to say about what, 3 years or so before the market was back up to where it was. Looking back, and then obviously we've had an incredible kind of bull run, especially in like the large cap arena, like since then. So, these things, when you're in the middle of it, obviously devastating. You know what I mean? Watching your account value, if you're a quarterly or a monthly checker of it, you know what I mean? You see those reports come in, that's tough. If you're someone who looks at it every day, obviously can be really, really totally your emotions. But then looking back, you look back 10 years later, 5 years later, 8 years later, and you say, oh, geez, like, that didn't even seem that long, right? You know what I mean? At the time, and you're like, no, that really was that bad for, you know what I mean, this long. And so it's tough in the moment. It seems like it may be different in the moment, right, than any other one we've been through. But, it's kind of like a forest fire that kind of clears out a lot of brush, right? And then those strong trees remain, and they continue to grow upward. That's what a lot of good stocks will do, and that's what we're working towards, finding those companies that, they may get hit during these times, but they're going to continue their growth and trajectory upwards, and then in turn, right, your account values are going up with them. So.
Yeah, the other thing, I look at this and I'm like, wow, this is amazing, because look how many months in total compared to the down markets, right, the bear markets, where it's just, we've been in bull markets. I think it's like 75% of the time, we're in a market that's going up and to the right.
Oh yeah, much more probable
Easily.
than not,
Yeah.
right? Much more probable than not. So, when you do investing in the market, right, you have to think, all right, what could potentially happen in the next 1 to 2 years, right? Like you have to almost go into your investment thinking like, yeah, I could potentially lose 40% of my investment, right? You know what I mean? In the next 1 to 2 years. Is that probable? No, not, you know what I mean? Not probable, but it is. It could potentially happen, right? It's more probable than not that you're going to gain money. Most years you're going to gain money if you're able to stay invested. But There are times where it does happen, but if you expand your outlook to, 3 years becomes much less likely that you're gonna, you know what I mean, be down money. 5 years, it's even less than that. So, and that's how you have to take investing, and you have to think of, the downside is, by not being in the market, right, is that your money is being eaten away by inflation, you know what I mean, and not growing for you. So, those risks, I think there's something that, because people can't see them, right, necessarily,
Right.
they take for granted, but they're very real and, and awful, right, to your financial future if you don't do the right things. So, so that's why it's so important, to use equities to keep up and beat inflation, right? That's the thing, so that your future costs, you're able to handle them.
Yep. The other thing, I mean, this chart also, just pop this up really quick so you guys can see it. What the market has done after each correction is also pretty amazing. But I think, like, if you're trying to time the market, it's almost can't do it. But it is remarkable to see these returns after each. This is for the S&P 500. But
Right.
after the closing correction territory, 1 year up 20%, 40%, 41%. I think this speaks volumes, just to, like, if you are afraid right now, it's like, hey, staying and invest in the long term, it's got to be good.
Yeah, no, certainly. It just is tough in the time, right? Because everything in our human psychology leads us to think, like, that those 2 red lines out of, I don't even know what the number was there, that it was showing, right, out of 25. Right. No, but
Right.
you look at those and you say,
Sure.
what if that happens? What if that happens? And look at the statistics on it. It's much, much more, you know what I mean, less likely. So,
Yeah, right, exactly.
Right.
and that's just 1 year. Never mind the long, you know what I mean, the long term, where, you know what I mean, where I bet you that could be even less red line, as few as there were. So,
Right. And I'm trying. So, yeah, I mean, over the long run, so the market, I found this remarkable. The market has increased over 16,000% since 1950.
yeah, I mean, we've had amazing technological gains in basically every area of the market, any type of sector, you know what I mean, things like that. Things have gotten
Yeah.
so much better. And the technology that that's out there, even from 10 years ago, is unbelievable. You know what I mean? Is unbelievable. And 10 years before that.
Mm-hmm.
So, I mean, I fully expect that to continue right into the future. I mean, if you think about everything that's going on with automation to make the average human that much more productive, it's going to be unbelievable. And so I expect the gains to continue in all areas, right?
Mm-hmm.
All sectors of the market, that they're going to see vast improvements, which will help.
I just find it
earnings.
interesting. I think as humans, we're all at least maybe Americans, we're focused on the short term. So short term, and we get down on ourselves, like, if things aren't happening fast for us in our in our favor. Whereas whereas other cultures, it's it's a long term view. We're looking at a long term lens, like, long strategy. We're playing the long game. This is fine, and I think that's just I find it fascinating. I don't know about you guys. Like, do you guys ever feel like just like, this? I put money in today, and, like, you're looking at it and it's like, it didn't go up, in a week, 2 weeks, a month. What's happening?
Yeah, I want to see it go up every day. Well, I feel like you're always
Completely realistic,
thinking about
right?
what you can be doing with it. Yeah.
Yeah. So are you guys thinking you're saying, just to kind of recap everything right now, is like, it's a healthy drawdown. It could set us up for a very, fortuitous future. in the markets. And,
Sure,
and
yeah,
just
I
stay
think
in.
it's a great time to get in if you haven't been in the market. Great time to stay invested if you've been invested. Actually, I pulled up JP Morgan research, who is our primary the primary research we use for our investment strategies. I have a quote from them. They've still kept their S&P 500 price target of 6,500. So for context, it's at 5,500 right now. So you're talking about quite a big increase if their prediction for where the S&P 500 is going to be at the end of the year is correct. And they expect volatility in the near term, but that price target remains. And a lot of that, they see like a lot of positives in global growth. Chinese economy coming back, European economy doing better, China pumping a lot of cash flow into the system.
Yeah, they're stimulating their market a lot right now.
Yeah, exactly. So there are a lot of positives. You have to look beyond some of the tariff stuff.
Well, the European defense stocks are doing well right now as well as they start.
That's because the U.S. might be cutting defense spending, and if that happens, they got to make up for it, right?
I think it hasn't been a huge.
They haven't had to defend themselves,
GDP, right? Things like that, and they're looking to bring that up a little bit. So,
and I think Germany has said they'll deficit spend in order to start ramping that production up.
Interesting.
So I think that's good. So European stocks are finally doing something. I think it is different from other drawdowns we've seen. Just recently, not all of the market has kind of collapsed, right, Eric? Is that you're seeing it really hit hard and concentrated?
It was it was a lot of tech and then retail momentum stocks like Palantir, Reddit, some of the nuclear companies. But that maybe it got overbought by non-institutional investors, maybe, but I still see some of those companies as something to invest in for the long term as well. But I mean, overall market has been hit though too. You can look at how the Dow's performed, but obviously those companies got whacked further. Like a lot of those were down like 30% versus I don't know, like Walmart being down 10%.
Yeah. Well, it was the other day, Bill. You were saying, BJ's stock, one of our holdings, popped, in a lot of the news. And that, and in addition to bonds are up, bond prices are up, gold is up. What do you take from all that?
Yeah, I mean gold being up, that's not surprising, right? Anytime there's any type of market volatility, right? It's kind of that flight to safety. Gold's been up, actually done really well over the last couple of years with a lot of nations. Buying up gold. But of course, anytime there's market volatility, right? Gold is gonna shoot up. I would love to see the stats on that, but like that's, in reverse, right? If we showed that this is what the market does, I'd love to see what gold does during those times. But then. Rates, bonds were going up because when market, right now they're looking at the markets and they're saying, maybe we're going to have a rate, right, decrease. And when, with that inverse relationship with bonds, right, rates come down, bond prices will, will go up, right? Because people are willing to pay more for higher yield, assets. So seeing that there. It's, could be a good sign, right? Like if rates do come down for the average consumer, you'll see your home equity line. If you're paying, home equity line of credit, you'll see that drop. That will give you a little bit more money on a monthly basis, which I think is always good for the consumer. It will either help you, you can use it more to pay down debt or on spending on things. So that, that will be interesting to see how that plays out.
Do you guys think Trump is like forcing Powell's hand?
No.
Well, no, because if
no,
think about this way, if you think about if inflation goes up due to tariffs,
they're
not going to lower rates. So,
but the market uncertainty is now, the VIX is at all time high, and so will I think the market is saying, hey, the increased chances of Powell and the Fed lowering rates is higher now. Right? They're expecting more rate cuts because of the uncertainty.
Well, I guess the question is,
I feel like the market would react
but
positively.
is Powell's job to react to markets, or is it to react to inflation numbers?
But consumer spending is softening as well. So will he take that into account? Right. So
yes. Yeah. We need to see more people. If he's going to lower interest rates, you need to see more people lose jobs, which Doge will likely cause, right?
Yep.
Twofold, right? From government jobs and from big contracts, corporations cutting people, which will then in turn reduce spending. But who knows how long everyone's worried about how long certain things take to go into effect, right? It's a big transition because you're assuming the private market then needs to create jobs to, sweep up those people who lose their government jobs. So basically, I feel like a lot of the market fear is that the transition won't be that smooth, and it's all happening very quickly. You don't just create jobs in an instant.
Oh no,
especially when interest rates are still high and money's leaving the system.
right.
So that's the fear.
But if the rates have already come down in the short term because of all this, right? So bond prices went up, 10-year went down. People are now refinancing. We talked about that a couple shows back. So it's, if that can happen simultaneously, or if Powell and the Fed kind of relent and say, great, we're going to cut rates further. I mean, Trump's last presidency, they cut rates almost to zero.
But that was COVID related, right?
Yeah, for sure.
That's such a
for sure. But it is,
different
I find it
situation.
interesting. Fight me on this here, but I think it is interesting, and it's going to be great for homeowners if rates come down.
Yeah.
Businesses, it's going to benefit, right? So you can borrow more money at cheaper costs, hire more people, fuel it into growth.
Oh, there's a lot of great things. You know what I mean? When interest rates come down, right? There's also negatives, right? So, again, getting this pesky inflation, you know what I mean? That we've been, I feel like talking about, ad nauseum for, the last couple of years here.
Yeah.
And every time we think that it's kind of nipped in the bud, it's we get a bird flu, we get a this, we get something like that, then that causes stuff to kind of shoot up again. I know that, again, the numbers, you know what I mean, on the inflation have come down, but
gas prices are at a historical low.
No, so I mean, there's
great.
It's all these levers of the market, right? That everyone has to combat with.
Yeah.
As they say, nothing's ever easy, right? So, there's all these things. I don't know though necessarily Powell, he seems to not, he likes his job. I don't really think he's influenced too much by Trump. He's more just looking at the numbers and what.
No, I think they're at a face-off, right? It's
I honestly think that Powell, he thinks independently. It's not a face-off. It's not. He doesn't view it as a challenge. He just doesn't.
He's a true economist.
He's just agnostic to the whole thing, and he's just no, I'm gonna do my job based on, what is going on. You know what I mean? What the stats are saying, what the thing. You know what I mean?
Mm-hmm.
It doesn't matter what our president's saying, and as Dolph tried to point out, right? He's I think he said something along the lines that he would try to replace him or something, you know what I mean? Something along those lines. But Powell just kind of, he had zero reaction. You know what I mean? Just so call it a face off, but I don't think it's, I think Powell's mind, I think he's just I'm going to do my job. And I know you don't have control, quote unquote, or too much control over what I do. So I'm going to continue to do my job. And that's how he approaches it, very matter-of-factly, so.
Mm-hmm. Mm-hmm. Yeah, no, it is. It's interesting. I think that, we might have some short-term pain, but overall, I think there's going to be a long-term, good in the market.
Yeah, most of these tech stocks, right, that you're looking at, they're, maybe their price to sales definitely shot up too much, right? You know what I mean? From where they were they've come down. Stuff's becoming, much more attractive on a valuation. These companies were before they were, they're all making a ton of money. They're expected to grow. It was more just like their expenses, right? You know what I mean? Like their capex of going out for AI. Are they getting the return on all this money that they're spending? That was the biggest concern. So we'll see. You know what I mean? We'll see how things go, but they're continuing to make a lot of money, continuing to grow. And I think as these technologies start to allow them to make money, right, as we start seeing that in the future, there'll be a lot of growth there. So, their earnings will go up, and in turn, their stock price will go up. So,
yeah, cool. Anything as we wrap up the show? Last words, like big takeaways for people listening. I think overall what I'm hearing from you guys is like, hey, corrections are normal. Weather the storm, it's okay. Are you suggesting people buy the dip, or do we say, maybe that's a personal decision? We don't, it's not something we're talking about here. I want to be clear on that.
I mean, if you have liquidity on the sideline, definitely, I think it's worth buying the dip. Just knowing what the market's done historically, knowing what analysts are predicting for growth for the S&P 500, I think it's a great idea. But if you need that money, market could still go down a little bit more. There could still be some more pain in the near term. So,
right. I think they say it's hard to catch a falling knife, right?
Yeah.
So when do you get back in?
I think the people who worry the most, right, are people who are at or near retirement. They're seeing their account balances go down. Those people, though, I think really, that's where you really got to stay the course. And it's important to, to do that, because you don't want to sell out at the wrong time. Get yourself into a situation where I'll get back in when things look better. That philosophy does not work. You will miss those days in the market, right, that are responsible for a lot of the gains that year, or a lot of the gains in that recovery. The market is so forward thinking. Okay. And again, it is, it's completely, to time the market is it's a losing philosophy. So as painful as it is, you're watching your account values, get hit a little bit. You need to stay invested, because you don't want to miss those days where those big jumps happen, those weeks, we're not talking about like 3 months that this stuff happens. It happens over like 10 days, 15, things like that. I mean, you think about how quickly a week goes by in your life. And if you say, I'm going to dip out, I'll get right in. You know what I mean? Like something like that, Dan. 12 days go by. You know what I mean? And then you're like, oh, shoot,
Totally missed it.
You know what I mean? I missed a 10% jump. I missed a 12% jump. I mean, that is going to hurt you in the long term. You know what I mean? It's going to be devastating, especially when you're talking about a retirement account, right? That may have, potentially hundreds or millions of dollars in it, hundreds of thousands or millions of dollars in it. That jump that's a lot of money. And you need to make sure that you're invested to take advantage of those times. And that's how you win in the long run. So
just to further highlight what you just said, JP Morgan research says, I think it was missing just the 10 best days in the market over the 20-year period cut your total returns in half.
I mean, think about that. That's insane, right?
10 days.
Yeah. And everyone says, I want to get out, but I'm going to get back in when things look better.
Yeah.
Right? You hear that.
Well, dude, the psychology of it.
No, you don't. You're not gonna, right? You're not a soothsayer. You don't know. But you know what I mean? Those days, it's impossible, right? It's proven over and over and over again, right? Trying to time the market is impossible. So, like Eric was saying, if you have some money, you have some liquidity, right? There's definitely some value out there right now. I mean, there's always value out there, right? But during these times, it's a little more prevalent, right? So maybe take advantage of that. But for the most part, you want to be staying the course, making sure your cash flows meet your future needs, and let the market let the market do its thing for you. Yeah, and then don't try to take advantage of everything.
But I think it's also, this is why it's important. You guys, I hear you guys tell clients this all the time, is making sure your short-term needs are, okay, right? So if I'm hearing that right, you don't want to be putting in money right now to buy the dip, because we don't know how long the dip will last, right? So if you need that money in the short term, you don't want to be putting it in and having to sell it right away. So not expecting that, like a short term.
Yep, exactly.
Yeah.
Kind of.
Yeah, I had a client. We had a client who's buying real estate in a few months and was asking, "Oh, should I?" We went to bonds actually, and I was like, "Hey, you could miss a little, come back in the market, but we'd rather lock in now and make sure the funds are there when you need to buy this property." So, yeah, it's the planning aspect's very important to consider.
All right. Anything last words for the show, guys? I think it's a lot of fun. A lot of fun. If you're listening, we want to hear from you. Email us at hello@foxhillwealth.com. Let us know what you want us to talk about next. We'll dive into it. And we're thinking of doing a live show as well. So stay tuned for that. And again, thanks for joining us at Wealth Wisdom. All right. Cheers.
And we're going, everybody. Bye.
Thanks.